Right, we're live. It is 6:48 Eastern on Sunday, the 21st of June. Welcome to another unmissable Sunday show. We've got a lot to get through. Do a little bit of macro at the start. We're going to talk about some AI and hyperscaler balance sheets. Then we're going to talk about what's going on with some certain equity factors. Then we're going to move on to FX. A lot to get done. How are you, Benny?
Good. I'm back in LA. We painted my office this weekend, as you can see in the back a little bit. We cleaned it up.
Looks
We're ready
good.
to go.
Listen. You got to move your mic because people can't see the banana, and there are a lot of people that are here for the
Oh,
banana.
I need to see
there
the banana? Okay.
The banana
And
didn't
the
get
banana's
painted
still
over.
there.
Fantastic. Well, listen, futures are open already, and they're pricing uncertainty again in the Middle East. I mean, we've got this sort of Schrodinger's Strait situation going on. I think we just need to live with a heightened state of ambiguity about that little bottleneck.
Wait,
right now.
Does that mean that Trump's going to get another rally out of this thing? He's going to squeeze this lemon again? Unbelievable.
I don't know. It's already law of diminishing returns. I mean, last time I checked, I think Brent was up about 2.3, 2.4%. Stocks are selling off about 50 bips. Dollar pretty unchanged. We'll get to the dollar again later. But I wanted to, we have seen this sort of monster flattener in the last week on the arrival of Warsh at the Fed, and I'm really scratching my head as to what the bond market is trying to tell us right now. Are we dealing with a super hawkish Fed?
Maybe. I mean, usually when you get a flattener, it means that the bond market thinks that things are too tight, or they're on the path of being too tight.
Yeah. Well, if you look what's happened to inflation slots, and this is the next slide, is that I think that market is clearly telling us. If you look what's happened to the implied market versus the actual CPI, everyone's giving him the benefit of the doubt right now on prices. We talked about this a little bit with Craigie on Wednesday, but I mean, I just sort of sense once again inflation complacency sneaking into the picture.
I mean, yes and no, right? I mean, it's been a pretty solid bond route this year. I mean, if you think back to the top of the bond market this year when I was trolling bond bears to the day almost, which is actually pretty funny. And
market gods will get
just
you
remember,
every
that's
time.
why you watch this show. We can make fun of ourselves and admit when we're wrong, at least in the short term. Still bond bull, but it's been a bit of a punch in the gut. But since then, you've had a great move in the US, but all year in UK, in Euro, and especially
Japan.
in yen, it's been a one-way train. And we're going to get to this, a few charts where I decided to pull up some old, let's look at policy rates versus the Taylor rule charts for the euro and the yen, and you'll see, it's a binary. There's either we'll talk about it. We can get to it in a minute.
We'll get there in a second. I just think right now, bonds trading with the energy complex right now. I mean,
they have been.
I think it's the same trade, right?
Yes and no. I mean, to me, the bond market clearly trades with oil when oil has a rate of change that's accelerated. So again, we used the 2008 analog a few times on the show this year, and you had that spike up, and that took the SOFRs, even though clearly the financial system was in a weak spot, right? Bear Stearns gets evaporated in March of 2008, and then the oil goes nuts, and commodities were going nuts. And again, we had a wild capex boom at the time also. It was just out of China. This time it's from data centers and AI. And then everybody was inflation. And then you're like, oh, there is financial reality, matter and antimatter with credit, right? And I'm not saying this is exactly that, but I'm just saying, remember that oil is the marginal driver of prices because it's the most important commodity. And in the US, it's not as big a deal. But in some countries like Japan, it is a big deal. Some countries like Thailand, it is a big deal. In Indonesia, which just raised rates. Because remember, if oil goes up, you can buy less oil with your currency. And then if people are front running and saying, oh, your currency is going to be weak, you almost have to defend it just to be able to not have to get a double hit on your energy dependence, in essence, is kind of what happens to the outer districts, to use Dave's Hunger Games analogy.
Yeah. I'm just wondering with these, I've got a small small sort of option short position at the long end of the bonds. I'm just wondering, given my size in energy, right? That's just a doubling up in position. I'm thinking about potentially taking that off.
I look, I think the long end's a trickier bird. Like, the long end's doing this now because they're saying, oh, we're tightening too much. It's getting too tight. This guy's being hawkish. Okay, we'll buy bonds. It flattens, right? And that's usually what happens. And if you look back to the period of 22, that was a monster flattener, like an all-timer flattener, right? And then flattened all the way till Jay Powell started cutting rates. And then, we got a little steepener action. But, like, I think that a lot of people looking for the steepener are looking for the end of cycle playbook, right? Because in 99, 2000, steepener worked well. In 2007, 2008, 2009, steepener worked really well. And so this is a elongated, this is like the 90s. Dave had talked about that deja vu and how much this looked like the 90s, and it's looking more and more prescient, especially now the Fed's talking about reversing course and raising rates, and everyone's raising rates. And it's like, that's what happened in the late 90s. You had the long-term capital management incident in 1998. You could say and to be honest, 25, the only time we saw the action between the dollar, equities, and bonds that looked similar was 98. And so that might have been our 98 moment. And then we had another 18 months or whatever it was. And so, you got 8 more months last year. We're 6 months into this year. So that's 14. So, guys who are looking for the end of this year, and look, time doesn't move linearly, so don't quote me on that. But I'm just saying that kind of thing of where they were hiking into the end, and then they did the death shot in June of 2000, right? They did that Greenspan did that 50 basis point hike. Here's the thing I'm interested in. Greenspan hiked while stocks were going down. Okay. Yeah. I'm not sure that they have the Kevin Warsh, who, by the way, kind of looks like Opie, from the Little Rascals. Just saying. I just had to get that out there. I don't know if he has the cojones, and that's what we'll see. Because one thing I'll tell people who are listening, as a guy who's been watching the Fed pretty closely for a couple decades, is they all come out and try to establish credibility, with the exception of Janet Yellen. She never tried to establish credibility. She just, I don't know what she is. But anyway, Bernanke was helicopter Ben. He comes in, he raises 17, 16 times in a row, right? In Greenspan, he had some moments of very serious hawkishness. Now, it was a different market back then, but even Jay Powell, he came in hot when he came in, if you remember, in 18. And I was a bear in 18, and I saw that, again, too early. I was bond bullish in the beginning of the year of 18, and we had to go through that moment, and the 10-year got up to 3%, and Rob Powell and all these guys are like, oh, we broke the long-term, the ultimate trend line chart or whatever that was.
The chart of truth, which I stole.
Yeah, whatever. I mean, to be fair, it was a good call. Now, you had to then, like always in markets, get really tested, because then the 10-year went to 50 bips before it actually broke through. But all I'm saying is that if he's trying to come in and establish credibility by being hawkish, the market will test him. And I think the big difference in this that we talked about with Paul a little bit, I think Paul was a little blasé, which I think he's a little blasé about everything. He's a very much establishment guy, let's say. And
Sharp world, baby. Sharp world
guy, yeah. He is going to introduce some volatility. Our buddy Charlie, friend of the show, Charlie Peabody, was talking about that. It's like, we didn't see a move like that day of in a long time, right? Forward guidance kind of allows the market to be pretty much priced in, and maybe he's trying to, reintroduce some vol, which I think would be a good thing, to be honest. I think, look, I'm a proponent of the pre-94 just no transcript, no press release. You got to look at the money statistics to know what's going on. But I would doubt we're going back to that world.
No, I think that might be a step too far. But, getting back to this late 90s analog, the whole AI story really pretty much needs to stay intact, right? If we're going to carry on seeing another, 12 to 18 months of bullish equity prices. Now, you put together this cartoon, which I thought was brilliant. I think the whole show me the money moment on AI ROI, if that's not a mouthful, is really beginning to come to a head. Just at the same time, and we touched on this last week, the super user is going to build his own sandbox and run open source models. I mean, I spent several hours this weekend trying to spec out what I might do, just with, to hell with renting GPU space from a cloud provider. This stuff is accessible for what I need from AI, and I'm not a frantic coder, but in terms of what I use these LLMs for, I don't think I ever need to rent tokens again in my life.
Well, so I thought about this a little bit. You're like, okay, I bought a car, right? So now I don't have to rent or a plane or whatever, right? Like, okay, so there's maintenance costs, and then there's going to be the value, and you're gonna fall behind the your model. You're gonna have to retrain a new model. You know what I mean? So then, if you have a model, is it really that people are going to train models and give them away for free? I mean, like, that doesn't seem economic either, right? Like, I don't think you're in the business, Rupert, of training multi-billion variable models. So that's, and by the way, right now it takes 15 weeks to get a Mac Studio that's over 96 DRAM, basically. And so you're going to be in a situation where there's going to be demand for this. So can you get it? And then the step up is expensive. So I hear you, but not everybody in the world is able to go buy a $20,000 hopper or whatever.
It's not even that expensive, because I don't. It depends on what you're using it for, right? I mean, if you are just a medium AI user, let's say I'm using it to have a sort of private agent to manage my archive, to digest my news flow, to basically work as a sort of chief of staff on my research business. I don't need a 230 billion parameter model to do that, right? And I'm looking at, 5 to 6K in terms of hardware capex to support something that's completely sandboxed. My data is entirely private. I mean, it's looking like a viable route here.
Yeah, and look, again, if the GLM 5.2 is what you're talking about, that a lot of people are talking about. If you guys are on Twitter, I'm sure if you follow anybody in the AI space, like that's and big name guys who've been in this space for a while are pretty like grown-ups, positive on
proper grown-ups.
Yeah, like proper guys. And so it is kind of like and look, we talked about this in last Sunday's show, the low energy Benny show. And but that's the point is, it's getting hit from all angles. The Chinese, LM models are open sourced and subsidized. There's one. And you got the local, and you got the squirrel spending his weekend trying to figure out a local sandbox in order to do this for himself. Well, there'll be an adoption curve to that, and that's very much early, like first inning, like maybe one out, right? Like on that for the average people who aren't at the very top of the stack. But if you think about what the LLMs are, that's what they're doing. They're doing that just at scale and hoping to have a model that they can then distribute out. If it truly is a commodity, go ahead.
All I would say is if there are enough people like me thinking about doing it, where do the revenues come to support all of these balance sheets, right?
Yeah, so that was a thing. I think if anyone saw, I put a little late night rant tweet out on last week in the middle of the week, and somebody, I don't remember who sent it to me, but one of my buddies in New York sent to me a chart that was like, okay, all the on balance debt that they have is, it's growing, but it's not significant at this point, right?
Yeah.
But the off balance sheet, which remember, I created this model using an AI council of a Chinese open source LLM that I use a lot, and then ran it recursively until I got comfortable, and then we compared it to some of the stuff. And
yeah, but just to be clear, it's all from public filings, right? So
it's all SEC,
there's no make
filings
believe in here.
or releases. Yeah, exactly. And no, but I guess my point is that it's funny that we're getting on their case, but like I was able to aggregate and do something that in the old days of me creating that spreadsheet would have took me a day or two, of my own time, and I was able to do that at nighttime in bed because I was thinking about it, and then I woke up and then was done. But like, yeah, there's a lot of commitments here. And so the idea that I started with is like, how much capital is actually being deployed here? Like, that's the actual question. Because when you just look at the debt that they're spending and then their cash flow, their capex from their cash flow, that's one number. But then we see all these, we had Amish Agarwal on the pod 2 weeks ago, and we were talking about this in, within the realm of CoreWeave. But like, there's a lot of extra money from private credit, from other players funding this. And you look at these commitments and these leases and these VIEs and SPVs, just reminds you of other times that financial shenanigans got involved, right? Off-balance sheet financing is a hallmark
Sounds
signature.
Like Enron's electric barges, right? I mean, it's feeling just like that right now. I mean, this is a bit a more numerical version of the same analysis, right? And I took a snippet of this to put into my weekend note, but I left off the conclusions, and I think, in terms of where the sort of soft underbelly is in this market, I mean, CoreWeave stands out by a mile, but it's interesting to see how high up the risk list Meta sits, right?
Yeah, well, I think that's the, so let's talk about Meta for a second, and then we'll continue with it. I think it comes out, okay, Meta is going to do a deal. Now they tested that balloon, but when you see the off balance sheet, which, if you remember, Rupert, Mike Green had pointed this out to me at Hughes event last August, and I was like, what? And then I dug deep into it, and I came back and I was like all bared up, and I was like, we got a short Meta at 770, 760, somewhere in there. And that dog has not hunted since then. It's been a kind of a one-way train down. And I think that if you really look at Microsoft's near the March lows of this year, and you see Oracle, same thing. Since then, you hit that 340 and got down. I don't know what the low was, 125, 130. Their CDS is blown out from 45 to, I think it's 157, 156 right now. Amazon, and really only of this group, Alphabet, Google's the only one that's really had a nice run. And some of that is just they own a huge chunk of Anthropic, and that is been a big beneficiary, and they've went from being, oh, we're going to get our business taken away, to, oh, we'll be a player. You know what I mean? So there was a re-rating of expectations of like, hey, they're dying, to, okay, maybe they're not dying. And this is the CDS of 6 of them. Nebius doesn't have CDS. The interesting thing, on this chart is CoreWeave. We got an amuse-bouche of what CoreWeave could do, right? Their CDS debuted last fall, right around that time in September when we're talking about, where the market figured out that, oh my God, these guys are levering up. Like they're taking up, like this is a different beast than we were thinking it was. And then you got pretty much up into the right move, with the exception of CoreWeave, right? Like recently we've had some comeback, but CoreWeave, is the only one that's really, but that was because it got so extreme because the market didn't think it was going to refinance. Plus, that's the most illiquid CDS of all those. So, dealers just keep lifting their offers like, oh, you want a yard? Okay, we're going to give it to you for 75 bips higher or something like that, right? But, I mean, this is a pretty clear trend, right? This is 1 year, basically, where we've seen all these things re-rate higher, with the exception, well, even CoreWeave's 150 bips higher.
but if you look at 480 over, right? How much of the initial targeted returns on invested capital is that eating up, right? Compared to where they were financing this at the early stage. This calls into question. I mean, your fellow Wisconsinian, Jim Chanos, has been pretty vocal on this stuff. I was listening to a podcast over the weekend with Jack Farley at Dean Knut's conference. Being the middleman here, right, with not spectacular sort of high single digit returns on capital forecast, that just simply doesn't work if your debt costs 480 over.
Well, yeah, I mean the debt is, look, let's just be clear. There's a debt distribution, or there's a debt table. So some of the debt's more expensive, some of it's less. Some of it has higher recovery rates, some of it doesn't. We're kind of assuming 40% recovery rate for the CDS because it's a blend, right? Remember, it's a blend of all those.
Yep.
And they're different collateral. So just remember that's just what the tradable market is for insurance, right?
Sure.
But I think the more telling thing is the private markets in Oracle are 325 to 375 right now. You're 156 right there on CDS. Private markets are 200, almost 200 bips higher, right? Like that should tell you what you need to know.
And this is,
and Oracle's a better business than CoreWeave, right? Like,
and this is before the market needs to absorb a whole lot of new suppliers. I mean, first we have Nvidia. Why on earth are they borrowing money here, right? I mean,
we talked about
that's just crowding out their customers, right? That just doesn't make a ton of sense to me, right?
It's
then,
not.
Of course, on top of that, you've got Elon, right?
Yeah, just he floated the Tesla doing for $20 billion, right, on Friday or Thursday? No, on Thursday, I think.
Yeah, just a week after raising 86 yards of equity, he comes for $20 billion to refinance that bridge that I guess he figured was not a great idea to refinance with his newly raised equity. But he said
he was going to do that in the IPO with the equity, didn't he?
Well, he couldn't speak about a public bond deal that he hadn't announced yet. It was just silent as to how that bridge would get refinanced. But here's the answer, right? And this triggered. We started talking about this months ago, but I finally I finally put some flesh on the bone this weekend on this whole supply issue, and I am going to put on the RSP versus QQQ trade, and I wrote that up over the weekend. I'll take you through a couple of quick images from here, which you'll like. So just actually before we move on from this slate, I mean, I kind of got fed up with the bad math and failure to read the prospectus as regards to the SpaceX IPO unlock schedule. I mean, here the numbers are. I mean, it is a constant drip in $50 to $80 billion slugs, with some jumbo ones coming in November, and then we've basically got in the next few months the free float quadrupling, and then it doubles again in November. That's an awful lot of stock, right? And then this is I thought it was a fun chart. This is, with the exception of Amazon, right? I really believe that so much of the outperformance by the big tech issuers over the last few years, and this is the QQQ versus the QQQ equal weight versus the RSP in blue at the bottom. I think so much of this is to do with de-equitization by big cap tech, and this is the shrinking share counts, with the exception of Amazon there. And then, finally, here we are. If we look at equity issuance plus stock-based compensation minus dividends and minus buybacks, for the first time since 2018, right, we're now back in positive territory. And I do think that is a real risk, even if my friend Dario Perkins was trying to make comparisons to concerns around bond supply in the past. I think that equity supply is a very different animal.
It is kind of amazing, because the balance sheets of those guys back in that pre-18 was just unbelievable. And
yeah,
and then they bought back stock, generated cash, didn't really have a lot of things to spend a lot of money on capex on. And I think that was like where the compounder bros like vests emerged from, like they were just falling from the sky from these hyperscalers, right? Like
So
basically
this is capex as a percentage of enterprise value, and I've included Apple in the mix here because really Apple basically stopped spending money on its business in the mid 20 teens, right? And then you can see that flash of green for Meta with the metaverse in 2022, and then finally, in the last 24 months, this massive spike up in terms of capex as a percentage of enterprise value. And this is the root cause behind this coming supply wall, which bothers me. Some are more sanguine about it, but I think this potentially really upsets the balance in equity markets, just as people are really beginning to question, where the returns are coming from all of this capex, which is the puzzle we need to solve over the next 10 to 12 months.
Yeah, I didn't even mention that because I kind of went off a tangent, but I made that cartoon based on Goldman's weekly chart, and we've talked about it for weeks. We've been talking about this for weeks of like the ROI, AI ROI is the new token maxing, right? And if Goldman's now talking about it, the street's focusing on it. I mean, how do you measure it? Okay, well, how you measure it now? Well, and then what's the pricing? And then what's the local model market percentage? And the Chinese, if you look at Open Router, keep taking share. Like, there's so many variables here that like we're just in the process of identifying what matters. Not even in the business of like completely forecasting, right? We're just saying, okay, what's fragile, right? That's how we come to CoreWeave, because that's the most fragile. That's the thing that like, if things don't go perfect, they're in a bad spot, right? That's the way we're thinking about it, because we're value investor or margin of error type of guys.
Have that bias. We're mean reversion guys. And, ultimately, this is interesting. It's a good segue into the next section. I don't know who it was who said, I think it was Brent Donnelly who said, momentum's doing an awful lot of work right now. And, I think momentum's done a ton of work for the last 10 to 15 years. And that's one of the reasons that I'm sort of slightly calling for a turn with this RSPQQQ call. But you put together a couple of interesting slides here. I mean, this is new breakout territory for momentum versus low vol.
Yeah, exactly. I found, I think BCA or somebody, Numera, somebody put a chart out, and I put it in my my WhatsApp channel that I have all my subscribers and my LPs and some of my buddies, the squirrels in there. And one guy was like, well, did you ever back test that? And so I built a model for that, and I didn't put it in here. But the idea is like, okay, it's not a bad question, right? Because it's easy when you look in hindsight at, oh, hey, 1999, it looked crazy, and we're in this like 3 standard deviation, 2.5 standard deviation off trend basis. Remember, by the way, this is a log chart, just so everyone knows. But then it went even farther. And like, we lost some money in SMH fading that in April, and other people did as well. And, some people did in May. And so the problem with the thinking is that, you're subject to, it could last another 6 months. It could last another 12 months. It could last, whatever. And so I actually don't have the numbers with me here, but I'll share them at some point. And so you have to think about what's the forward return. So it's more than, hey, shorting it. It's just that your integral of the distribution of outcomes is smaller and smaller. And so you need things to really go right. And remember, what's momentum? Momentum is a crowded trade. It's everybody's going into the same thing, and there's not enough supply to offset it. It could be a uranium miner. We've seen that before many times. Could be, anything where like things that are working then attract more capital and keep working, and they get stupid, and then you add leverage, and it's just the same underlying mechanics always.
And then the supply problem gets fixed, which is where it ties neatly with what we've been saying for the last few weeks. And I really do think that the supply is coming in the kind of volume that could easily fix it. Right?
Yeah, and that happened in the 99, 2000s. And it wasn't just IPOs. The secondaries were really the hammer, basically, is what I think is a less known story. Let's go to the next slide.
Yeah. So, I mean, this is the same thing, which just plotted against correlation, right?
Yeah, I just wanted to show that as like, because we've showed this in the past, and basically this is high beta versus low vol, but it's similar concept. And just remember, there's a financial mechanic under there that's going on as well. This thing's at the highs, implied correlations at the lows, and they're related, right? The dispersion trade, the amount of leverage in the trade, and these are related topics where it's these guys who are doing this trade don't give an F about what you think memory earnings are going to be in 2028.
Absolutely right. And interestingly, I wrote about this as a sort of afterthought in my weekend note. I mean, what is the dispersion trade? These guys are short index level vol and long single stock vol. What are they long most of in terms of those single stock vol positions? It's the hyperscalers, obviously. So, the extent to which that dispersion trade unwinds, that's a flood of additional supply in large cap QQQ stock. So this is why I think it's particularly vulnerable.
Yep. All right. Well, everyone's seen this before. Just showing you the extreme relative vol of NASDAQ tells the same story.
Okay. Listen, we're running slightly over, but I want to carry on. So let's switch to the dollar. Yeah. I mean, that was a big move last week. Finally, we saw one, Benny. You got your dollar ripper. It's cooled off a little bit this morning. Take us through these Taylor rule slides, because I think it's interesting.
Yeah, I mean, there's a guy named John Taylor who kind of created an equation that I remember learning in grad school when I was managing the university trust bond fund. And it's kind of a rule, but it's like an idea of where roughly policy rates should be. And that's what people would say. Warsh might be taking us more toward a Taylor rule world, where we're going to follow the data. We're going to get better data, is what he said, if you missed that on his conference call. And this is the yen, right? The yen policy rate is a goddamn joke. And so when you have that negative of real rates, it's a long way up to get them just to zero. And so that's why I'm just an ultimate yen bear until these guys show that they're in any way serious. And they didn't again last week. On Tuesday, they basically punted to the Ministry of Finance, more or less, it seems like. And we've seen the Ministry of Finance come in and do these interventions. And I had a chart, I didn't show it, gets bopped on the head. Sometimes people wait for a little second bop, and then it goes back. We talked about that with Brent Donnelly, because that was right after the intervention. Yeah. But again, the yen just broke through that 160. We're now in the 161 territory. It doesn't take long, and we're at 175. Or we're at a level where the BOJ is going to have to change their tune, and then that could disrupt things quite a bit. And there we are, just getting ready. And this line, if you took this back to 1990, we're at the 1990 line. You know what I mean? This is a big line here. This is for guys who like charts. This 160, 161 line, it's a big one. It's like that line of truth for the 30-year bond.
Okay. Well, let's take it sort of so the big one for the Dixie, which is of course the euro, right?
Same thing.
Yeah, it's a similar story. I mean, the delta is a little less extreme to the Taylor rule line, but yeah,
it's the same thing. And Europe can't. They already have probably too strong of a currency. They're between a rock and a hard place, if you will. If they let their currency go, that's not great for German car companies. It's not, they have a decent exporting ASML, and they're also at a break line, not quite as big of a break line as the yen, but we've come up against this 113, 114, 112 level a few times, and let's see where we go. But point is they're also those are two energy dependent guys. No one's more excited about oil prices are coming down than them, because they're in the position where they have to raise rates in order to fund LNG, to fund oil. And so, yeah, I would say they're both in very, very precarious positions. And the thing is, let's go back to the what we've talked about many times, which is, where does this play out then? It's got to be an FX vol, right?
As we said, the dog that didn't bark. I got a message from Kevin Muir, our pal, when we put out the Brent show with that title, the FX vol dog that didn't bark. He said, "God, you're really tempting fate here now." But it's true. I mean, it's still on its arse, right?
Oh my God! Well, the Euro GBP variance swap, if anyone could put that on, that is just like the cheapest convexity in the market. Okay, and you can see both the 25 delta. These are 3-month 25 delta for all the versus the dollar, and it, the euro and the sterling vols just on the floor. Yen's elevated some, but still, we're not anywhere clearly where we can go. And if you pulled this back farther, you could see where it could really go. And so, I don't know. We'll see what happens. But I think the yen leads policy rates, and then policy rates can lead carry unwind. FX vol maybe is what the lever in between credit markets, equity markets rolling over would be. So I think that's the thing to keep an eye on. BOJ being number one, but the Euro's important as well, especially, as you said, for the perception of the dollar, right? The DXY is primarily, it's primarily yen and euro, but it's mostly euro. What's it, like 58% euro or something like that?
Okay, so I mean, not a lot of our guys can put on variance swaps right now, but let's just translate that into, dollar up, FX vol up, energy potentially back up. It's not a great backdrop if the whole narrative behind the current Momo rally is being called into question.
It goes back to the four horsemen, right? If the four horsemen are going against you, it's tough. And again, we're at very elevated levels. I don't know. It was a couple weeks ago we showed a chart that showed the average of all of the major valuation metrics were 99 percentile on like the 100-year look back or something like that, right? Like there's not a lot of margin of error. Now there are cheap stocks and there's cheap areas, the low vol stuff, the consumer staples stuff, the rate sensitive stuff, bonds themselves are all interesting, sovereign bonds that is. Credit spreads are just way narrow, rising a little bit, but narrow. Equity valuations as a whole. Now I know that over time that changes who's the leader, who's the composition, but like you're not dealing with an overwhelming margin of error here on a lot of uncertainty.
Listen, if you look at just as the S&P, right, you've got half of the S&P by market cap trading at above 10 times forward sales, right? That's kind of all you need to know. It's higher for the NASDAQ, and that's before you've got the inclusion of SpaceX, OpenAI, and Anthropic, right? Yeah, valuation doesn't matter until it matters. Anyway, listen, we've overrun a little bit, but it's always fun. We had a lot to cover this weekend. We have got Rob Wu from Baiguan News to come and talk all things China. Really interesting guy. He writes about equity markets, but more interestingly, perhaps for discussion on Thursday, he runs one of the best big data businesses in China. So he's got some really interesting data sets in terms of what Chinese consumers are doing. Anyway, we've got him chatting with us on Thursday. Until then, everyone, stay safe out there. It's going to be a bumpy week, I think. Benny and the Squirrel out.
We're out.